Hi, I'm Karim Chedid, head of iShares EMEA investment strategy. My team works to connect BlackRock's macro views with actionable investment ideas for EMEA investors. Today, I'll be answering some of the key questions clients have been asking us lately on the investment case for China in 2022. China is impossible to ignore. Over the past several decades, it has grown to become the second largest economy in the world. Yet, we see untapped potential as foreign investors still only own a small part of China's equity and fixed income markets, 4.3 and 3% respectively. China's investment market has grown substantially over the past 15 years, with the number of listed domestic companies nearly tripling between 2006 and 2020. Similarly, we've seen significant growth in China's bond market, which has increased in size more than 6 times between 2009 and 2020. With over 4,000 listed companies in China, the stock market offers access to all aspects of the economy and allows investors to benefit from this fast-growing and comprehensive and under-owned asset class. For investors comfortable with the inherent geopolitical risks with investing in China, we see even more potential there over the coming years as the country increasingly focuses on its 4 S's: sustainability, self-reliance, social equality, and of course, data security. A key challenge for China's policymakers in 2022 is balancing the zero COVID strategy, which is gradually getting softer, while meeting a growth target of around 5%, which will probably stay a hard target. But we expect domestic consumption and green investment to be more prominent growth drivers in the coming years. We don't expect the recent market volatility to impact the investment case for China, especially as we maintain a strategic overweight to Chinese assets. Sentiment towards Chinese onshore equities has continued to lag year to date, whereas sentiment towards Hong Kong shares and offshore Chinese shares, on the other hand, has remained very resilient so far this year, especially relative to other equity markets. It may be supported by a favorable index composition. Financials make up 1/3 of the Hang Seng index, for example, and may benefit from an improving profit growth outlook given rising rates. A tilt to technology and thereby access to long-term structural growth drivers should also be supportive, with peak regulatory tightening now behind us in 2021. Despite downward pressures on equities year to date, stability in both the economy and financial markets will likely be a top priority for Chinese policymakers in a politically sensitive 2022. Context is everything. 2021 was characterized by intense regulation in China, both from big tech to property markets. And 2022, this focus is starting to wane with a shift towards an easing bias. As growth momentum has slowed, this clear easing bias is coming through, most notably in the form of monetary policy, with the PBOC cutting policy rates, as well as the required reserve ratio. In order to meet the annual growth target of 5%, we expect more to come, especially as economic data continues to come through mixed, given the impact of Omicron and the impact of strong exports whilst retail sales continue to lag. Opportunities have opened up to invest in areas prioritized by new policy mandates, such as the Common Prosperity Mandate. So a focus on quality, not quantity of growth that is both sustainable as well as equitable. And dual circulation, which is increasing reliance on domestic consumption in China as a more primary growth driver and creating more self-reliance with regards to supply chains. This may reflect policymakers' desire to transform China from the world factory or low-cost manufacturing center to a business model and a tech innovation hub. So we see tailwinds for the tech sector and themes that align with China's long-term sustainability-driven growth drive, such as data and cybersecurity. And we see strong demand led by the government and the private sector into tech, hardware, software, and semiconductors. We also expect more green capex and transition investments to come. For example, the industrial sector requires an upgrade of its production equipment to be more energy efficient. In order to accommodate more solar and wind power, investments may be used to improve electrical grid and transmission lines, as well as more electricity storage facilities. Finally, electric vehicles are a key area that we expect to grow. While we maintain a moderate equity overweight globally, within our equity allocation, our preference is for developed markets over emerging markets. In fact, we're neutral emerging markets within that context, given a more challenging restart dynamic as these economies face a more permanent growth shortfall from the pandemic relative to developed markets and tighter policies in emerging markets in the run-up to the Fed rate hiking cycle. We continue to allocate to Chinese assets separate from emerging markets. We maintain a strategic overweight on Chinese assets. China is a global growth engine, and we believe Chinese assets warrant allocations that are not only separate from emerging and developed markets, but also above benchmark weights, because we see that benchmark weight underrepresents China with the limited weighting. And we continue to see China underrepresented in foreign institutional investor portfolios. Analysis from our portfolio consultants here at BlackRock shows that China remains broadly underrepresented in most EMEA client portfolios compared to benchmark. Despite China's weighting of close to 6% in MSCI ACWI, which is already limited but is the third largest country exposure, the average standalone allocation to China in EMEA portfolios remains below 0.5%. So that's a big difference. We believe that the very small index weights and client allocations effectively represent a large structural underweight to what is effectively the second largest economy in the world. And we see that this could increase significantly over time. Our strategic view already takes into account that China is unmistakably on a path towards greater state involvement, with social and political objectives taking primacy over economic ones, leading to greater risks and the need for a new investment lens in this space. But context is everything once again. While our allocations to Chinese assets are above traditional and typical benchmark weights in our strategic asset allocation view, they do remain far below those of developed market assets.